20 businesses. So I am comfortable with the startup phase as well as the operations phase of business, and look forward to continue working with my clients. I'm going to go ahead and give you a little bit of information about SCORE for those of you that are not familiar with it. We are a nonprofit organization dedicated to helping small businesses start up, grow, and achieve your goals through mentoring and education. We've been doing this for more than 50 years. SCORE actually started as a local volunteer organization in Baltimore, Maryland, and today we are national with 240 chapters around the country. Our mission is to foster vibrant small business communities through mentoring and education. We aim to give every person the support they need to thrive as a small business owner. Our focus is small business. We do this in a couple different ways. Number one, mentoring, face-to-face, where we will meet with you, and remote, video, email, telephone mentoring. The majority of our mentoring is video. We do some face-to-face when it's appropriate. I've met with several clients face-to-face to make sure that what they're doing is what they need to do and to give them a comfort level. We also do a lot of workshops and seminars, business startup, business planning, marketing, finance, all kinds of ones. This is just one. This workshop today is just one of about 100 that the Cleveland chapter will put on in 2025. And district-wide, Ohio district, and regionally, there are hundreds more. So we do this to cover as many business topics as possible. We will also do a board of advisors. We don't do a board of directors, but we will do a board of advisors for you. Because our work is supported by the U.S. Small Business Administration and a few generous sponsors, and thanks to our 10,000 volunteers around the country, we're able to do everything that we do for you, whether it's one-on-one mentoring or these webinars, anything else, at no charge to you. So it's really to your advantage to take advantage of what SCORE can do for you. And at the end of this program, we're going to talk just very briefly about how you can sign up to get a SCORE mentor if you don't already have one. And for those of you who haven't seen our website, our chapter website is www.score.org/Cleveland. And this is what you'll see there. This is what our chapter website looks like. You'll notice that we were 2022 National Chapter of the Year. We were also 2024 Ohio District Chapter of the Year. And that's just Cleveland. There are excellent chapters all over SCORE, all the way from Seattle, which was the 2025 National Chapter of the Year, all the way down to Miami and everywhere in between. Okay, at this point, I'm going to turn it over to Chris, who's going to give you an introduction on how to make more money in your business.
Great. Thank you, Richard. So we're going to get started really just hitting some basic vocabulary just to make sure we're all on the same page. We're going to then talk about how you can calculate profitability in your business. And once you know your profitability, you can use that information to calculate what's called break-even analysis. We're then going to continue with talking about the different types of accounting that are out there. We're going to look at some basic financial statements that have been simplified to give you the general overview and gist of what kind of information you can glean out of them and how that can be useful to managing your business. And we're going to talk about the variety of financial service providers that are out there. So just getting started and getting used to some basic vocabulary, you have money coming into your business and you have money going out of your business. And tracking all the money coming in and all the money coming out is how we're going to start to do other calculations with those numbers. So any money that's coming into your business in a business world, we're what going to generally refer to that as revenue. And any money going out of your business is what we're going to call expenses. And if we subtract all of the expenses from all of the revenue, what's left over is your profit. Now, this profit may be positive, you're making money, or that profit could actually be negative, and in that case, you would be losing money. So sales is the same thing as revenue, and your costs are your expenses, anything that costs money when money is going out of the business. So there's a little asterisk. There are other ways that money can come into your business, like income from your bank account that might have interest that comes in. But for the most part, your money coming into your business is going to be in the form of sales. So money going into your business, money coming out of your business are the things that we are really going to focus on to get started. So the money going out of your business, the expenses are in two different categories. One category is called a fixed expense, and the other is called a variable expense. So the fixed expenses stay the same every month, regardless of your sales, or it could stay the same every year. So these are things like your insurance or your rent. It's not going up, it's not going down. If you sell 1,000 widgets, the expense is the same. If you sell none, the expense is the same. The other type of expense is a variable expense, and this expense is directly related to the amount that you're selling, either of a service or a product or whatever it is. As you sell more, this expense generally increases, and as you sell less, the expense decreases. So what are some examples? So our fixed expenses, the things that do not change, are things like your utilities. Now, it might be that in the summer for your electric, that the air conditioning is going to be more expensive than in the winter time, but that's still consistent month to month, month over month, and year to year based on the seasons. It's not in any real way directly related to your sales. Things like auto loans, just a flat amount every month, your rent, your insurance, salaries that you pay, and if you have anything like loans for equipment or other loans that you are paying off, that'll be a flat, steady amount every single month. Your variable expenses, again, are going to go up and down based on your amount of sales. So if you are paying people on a commission basis, as there are more sales, they'll make a flat amount of commission, or they might have tiered commissions at different levels, but those amounts are going to increase as the sales increase and decrease likewise. Marketing is considered a variable expense. Your raw materials are a variable expense. Shipping charges certainly are variable. The more you're selling, the more you're shipping, the more that goes up. And your direct labor, or what you would call hourly labor. So you can have salaries, which are fixed, and you can have direct labor, which is variable. And you might even have some employees where some of their income is what would be considered fixed, and some amount of their responsibilities are directly related to the sales, which would be variable. So we're going to go through some different examples to show you what do these fixed and variable expenses look like in a couple different businesses. So we have a fictitious business. The first one we're going to go through makes a product. They are a puzzle manufacturer. So we're going to first look at their fixed expenses. These are the things that do not change month to month. You've got rent, $3,000, telephone, 100. Their insurance is 300. They have salaries for 5,000. So salaries might be someone that is an office manager, or they might have someone, and the office manager is not involved with making the puzzles at all. They're involved with managing the puzzle. They might have someone who's on staff in human resources that they handle payroll and they handle benefits and they handle employee reviews and things that are not related to the production of the puzzles, but are still a necessary component for the business. Internet service is 120 and utilities are 550. So every single month, whether they sell one puzzle or 10,000 puzzles, they are going to need $9,070 to pay their fixed expenses every month. Their variable expenses are going to look a little bit different because variable expenses are expressed as a percentage. The reason they're expressed as a percentage is that, like I said, when the volume goes up, the amount goes up and the volume goes down. So the easiest, I think, part of this to imagine is if you're making more puzzles, you're going to have more raw materials. So in Puzzle Mania's case, their raw materials account for 15% of their expenses. So that while that doesn't sound like a lot, there's a lot of other expenses tucked into it. So the raw materials might be chipboard, it might be the top layer that's printed, it might be the ink that they're going to consume more ink or however they're printing that top layer. Anything related to production like blades or cutting that need to be sharpened, the boxes that the puzzles go into, and any of that material will all be part of those raw materials. So you can see the more puzzles you make, the more raw materials, and that 15% should remain fairly consistent. They also have wages. So these are not office people doing general work. This is specifically related to the people that are making the puzzles. So again, as you're making more puzzles, you need more people loading chipboard into a machine or working through the cutting machine or whatever the processes are. More puzzles means more people, means more wages. The credit card fees are a flat percentage that's attached to any time they're processing credit cards. Their shipping expense is roughly 3%, and their marketing is 8%. So their total variable expense per month is 49%. So we know now their fixed expense is 9,070 and their variable expense is 49. So we're now going to look at what is their revenue looking like. So in October, Puzzle Mania sold 1,500 puzzles at $20 each. So if we multiply 1,500 puzzles times 20, they're looking at $30,000 in revenue for the month. That's all the money coming into the business. Now we're going to look at their profit. So again, we're going to subtract their expenses from their revenue, and the expenses come in two categories. For the variable expense, we're going to take 30,000 and we're going to multiply that times 0.49. That's going to give us 49% of the $30,000 of revenue. That comes out to just under half, which that makes sense, 14,700. If their variable expense was exactly 50%, that number would be 15,000, exactly half of 30, but it's slightly less than that. Their fixed expenses, we know we're subtracting our 9,050. So what's left at the end of the month is $6,230 of profit. And then we can divide 6,230 into the monthly revenue of 30,000. That'll tell us that our profit margin is 21%. Solid profit margin. One thing, especially for new businesses, make sure if there's any profitability going on that you set aside money to pay taxes. One thing that a lot of new businesses get stuck with is they start bringing in revenue, they start making money, and they don't account for these taxes, and all of a sudden it's tax season and they're kind of stuck without the funds. They've spent it, they thought all that profit was theirs. After the first year, you will then be required to pay quarterly estimated taxes based on the prior year's profitability. But that's why this is so sticky. In that first year, there is no prior year. So you're going to be responsible for that. And like I said, once you get in the groove year after year, you'll pay those estimates quarterly based on the prior year. But when you're getting started, it hits a lot of people and they're not prepared. So think about your taxes. Okay, moving forward, we're going to talk now. You've figured out what your profitability is, and now there's something called a break-even point. And this is the sales level at which your total revenue equals your total expenses. So basically, you're not making money and you're not losing money. It's exactly what it sounds like. You are breaking even. So the way to calculate this is to take your fixed costs, those are the things that don't change month to month, and you're going to divide that by something that's called a contribution margin. Your contribution margin is the unit price. So in the example we just used, that's $20 per puzzle, and you minus the variable cost per unit. So in this case, it was 49%, so we would multiply $20 times 0.49 and subtract that from the price. That's going to tell us how many units we need to sell. So in the case of Puzzle Mania, we know our fixed expenses. We already had calculated that out. It was $9,070. And we know our variable rate is 49%. So we want to take our fixed costs and divide by our contribution margin. So again, to calculate this, we have $20 is the cost of the puzzle. We multiply that by 0.49, which comes to $9.80. And if we subtract $9.80 from $20, that gives us a contribution margin of $10.20 per puzzle. Now we're going to divide that top number, our fixed costs, $9,070. We're going to divide that by $10.20. And that's going to tell us we need to sell 889 puzzles for us to break even and cover all of our expenses. If we multiply 889 puzzles by their unit cost of $20, we know we need to sell $17,780. That's the dollar that is our break-even point. If we sell more than $17,780 or more than 889 puzzles, we're going to be making money. If we sell less than either that number of units or that dollar amount, we're going to be losing money. So this is a very, very helpful number for each of you to know for your businesses, because it tells you, are you on track or are you off track? So the longer you're in business, the more this kind of information can be used for all sorts of management decisions. Do you have slow periods where you're running consistently in the red or in losses, where it might be time to say, employees should take vacations, or you're going to do some other kind of work to fill in because you're consistently seeing that you're under your break-even point at certain points of the year. Or you know that you can handle maybe losses in certain months because you know that you're very, very profitable in other months. But it's important to know how profitable are you, and for a variety of other forms that we're going to see as we go through looking at things like cash flow projections and so on. This information is very helpful in you making actual business decisions when you see your sales and you know some of these numbers. So like I said, if you sell more than this amount, you're going to be profitable. And if you sell less than this amount, you're going to be incurring losses. We're now going to do the exact same thing, but instead of a manufacturer making a product, we're going to look at a service business that sells services. So this is Lulu's Beauty Salon. They have very high fixed expenses. You'll see they have expensive rent of $4,600 a month. Their telephone is $300. They have $1,200 for insurance. They have one manager, which is costs the business $3,750 a month. Their internet IT website is $820, and their water, electric, utilities, all of that is $750. So every month before they do anything, they're going to need $11,420 just to cover their fixed expenses. On their variable expenses, you can see one thing really sticks out is the huge expenses, the commissions. Their shampoo and conditioner is very, very low, 2%. Their hair dye and perm kits cost a little bit more, but they're still very, very low at 7%. They are heavily commission based. So the other stylists that work at Lulu's make most of their money in the form of commissions plus their tips. So that is a big part of the variable expense. Credit card fees are 2%, marketing is 4%. So their total variable expense per month is 60% of their revenue. So how much revenue does Lulu's have coming in? They're a very well-established and busy salon. They have, on average, 18 clients a day, 6 days a week. So we're going to multiply 18 clients times 6 days a week is 108, and there are 4.3 weeks in every month. So their average service is about $120. Some services are much more, some are less, but we are taking averages. This has been brought up by a couple of questions from this account. Many businesses don't know exactly what their marketing costs are, or don't know exactly what their variable expenses are. And the best way to calculate this, because it goes up and down from job to job, excuse me, is taking averages. So that's exactly what this average service is. If they have a certain amount of revenue, excuse me, in a given month, and they have a certain number of services, they divide the total number of revenue by the total number of services they provided, and that'll give them an average amount per service. So one might be $300, one might be $60, but overall it averages out to 120. Excuse me. So to see their revenue, we're going to take the 108 services per week times 4.3 weeks times $120. So Lulu's is really killing it. They brought in $55,728 for their monthly revenue. We're now going to subtract Our expenses, which again are in two different forms. Our variable expenses are 60%. So we're going to figure out that number. We're going to take 55,728 and on a calculator, just multiply by zero point 0.6. That's going to give you the 60%, which is $33,437. The fixed expenses, you don't have to keep calculating month to month because they should be the same. So we're going to subtract both our variable and fixed expenses from their total sales or revenue. And we see they have a profit of $10,871. And again, to figure out profit margin, we're going to divide that number into their total sales for the month, 55,728. So we see Lulu's has a profit margin based on this volume of sales of 20%. Now we're going to look at Lulu's break-even point. How much does she have to sell to cover all of her costs? She's not making money, she's not losing money. We know her fixed expenses, 11,420, and we know her variable rate is 60%. So we're going to calculate her contribution margin. Again, to calculate her contribution margin, we're going to take her unit price, which is an average of $120 per service, and we're going to multiply that by zero point 0.6, which comes out to $72. So if we subtract $72 from the service of 120, that tells us the contribution margin is $48. So now you're going to go back to your calculator and you're going to take 11,420 divided by 48. That's going to tell us that she needs 238 clients to break even. If we multiply 238 clients by her average service of $120, we see 28,560 is what she needs to sell to cover all of her costs. That's her break-even point. If she sells more, she's going to be profitable. If she sells less, she's going to be losing money. And again, that in and of itself is not a problem. Many businesses have months where they have known historically they're going to be very profitable and months where they might be losing money. And it's all manageable. It's not a good or a bad thing. It's just important to know when are those months and how do you handle them. Okay, we're going to look at one more example, which has some other different kind of things going on. So this is Walter's window washing business. He's got not a lot of fixed expenses. He works out of his home, so he doesn't even have any rent to pay. His truck lease is $600 a month. He's got insurance of $150. He's got liability insurance that's different than his auto insurance for his services and what's going on if anyone gets hurt or any damage happens. He has health insurance that he pays. That's quite a bit of money, but health insurance is expensive. His cell phone is $100 a month, and his website and internet is $100 a month. So his total fixed expenses are $2,600 a month. For his variable expenses, again, the things that change as his volume changes, gas is very expensive for him. It's 10%. So again, as he does more jobs, he drives around more and he has a higher amount that he pays for gas. His cleaner is pretty inexpensive, 4%. Rags and towels, 3%. Credit card fees, 3%. And marketing is pretty low. He's mostly word of mouth, 4%. So his total variable expenses per month are 24%. Walter can service 2 clients a day, and he really is only able to work on average about 4 days a week. And this is because in Cleveland, our weather is very unpredictable. We have a lot of rain, a lot of times where he's just not able to clean. So he is able to get in 2 clients a day times 4 days a week. And times 4.3 weeks in the month is all that he can do. So he's not working all the time. His average service is $300. So if we multiply 8 clients a week times 4.3 weeks in the month times $300, he is able to bring in $10,320 in a month. Now, when we're looking at this, that seems like a lot of money, but we also need to consider this is seasonal and he's not window washing in usually January, February, probably a good part of December. So those are other factors to consider. But just on a monthly profitability, he is really killing it. He's got $10,300 and $20 in sales. We'll multiply that times 0.24 to get 24%, which comes to $2,477. We minus his fixed expenses. He's left with over $5,000 of profit for the month. And if we divide that into his revenue of 10,320, he has a profit margin of 51%. Seems amazing, and that's a great profit margin, and he's only working 4 days a week, but he really has to figure out from a cash flow standpoint how he's going to manage in the winter months without this window washing revenue, because in the winter months he still has all of his fixed expenses. Those don't go away. If he's not washing windows, he won't have the variable expenses. Those will go away, but he still has to cover $2,600 a month, even if he's not washing one window. So we're going to see what is his break-even point. We know his fixed expenses, $2,600 a month, and we know his variable rate is 24%. We're going to take the 2,600 and divide again by his contribution margin. His contribution margin is taken by taking the price of an individual service, which is on average $300, and we're going to multiply that times 0.24. That comes to $72. We're going to subtract $72 from the 300, and that'll tell us that his contribution margin is 228. So again, for those of you that are thinking about your own businesses, he might charge one homeowner $150, and he might charge another homeowner $550. And when you look at all of the money that you have coming in, and you add it all up together and you divide by the number of services, that's how you're going to get your average price per unit. So the $300 does not mean that Walter charges everyone he goes to $300. That's the average that we've looked at. And in reality, the more time you're spanning to see what your average is, the better your number is going to be. So as an example, he might want to average just June, and then just July, and then just August, and then see what is the average for each of those months. Then he might want to add all 3 of those months up together and average it out between a 3-month period. So you can continue to play with these numbers until you have confidence in both your average expenses, your costs. You can see these variable costs and take it over time. So another thing is, if you're buying boxes for your puzzles, you might buy large amounts of boxes 2 times a year. but you're going to see that expense come up in that monthly expense. So this is why looking at larger periods of time and averaging things out is how you come up with these numbers. They're not necessarily visible if you're just looking at your accounting on a month-to-month basis. So this is a real helpful thing, I think, to have a score mentor. If you are thinking, I would love to know what my break-even analysis is, I would love to understand my profitability, you can absolutely, if you don't already have a mentor, request a mentor that can help you figure out what your average costs, services, variable costs, all these things are. And like I said, it's all built on the more data you have, the better your averages are going to be. Okay, so back to break even point for Walter. We're going to divide 2,600 by 228. That's his contribution margin. And that tells us he needs 12 clients a month to break even. If we multiply 12 clients times $300, he needs to bring in $3,600 a month to break even. Now, we know because this is a seasonal job, this is just breaking even for the months where he's able to work, but it does not account for the time when he can't work. So that's, again, we can go through different calculations that are similar, all based on the same information, and see how are we going to cover his $2,600 through those cold winter months when he doesn't have window washing revenue. So again, his break-even point can be expressed either in the number of services, which in his case is 12 clients, or as a dollar value, which in this case is $3,600. If he does more than 12 clients, more than $3,600, he's making a profit. And if he sells less than this, he's going to be losing money. So you might be wondering, how do I get all this information? How do I know what all of my expenses are, what my revenue is, how many services I've provided? So the quickest and easiest route is if you have some accounting software like QuickBooks, FreshBooks, Peachtree, whatever. If you have that in there, it may or may not be completely up to date. It may or may not be completely accurate, but it's a really good place to start. If you don't have accounting software, you can absolutely still do this. It will be a little bit more challenging, and again, why I think a mentor can be really helpful. But on the revenue side, that's all the money coming into your business. You want to look at the deposit section of your bank statement, any point of sale system that you're using, any paper receipts, any apps, Square, Venmo, Cash App, Zelle. If you are on a platform like Shopify, Etsy, Amazon, that they will have your data that you can look at, for whatever periods of time you ask it to give you that data for. On the expense side, you're going to look at the debit section of your bank statement. You're going to see what checks have you written, any paper invoices, vendor account histories, credit card bills, employee payroll, and any 1099 contractors you might have. If you have not kept track of all of these types of expenses, it usually is not a problem to call any of your vendors and ask them for a summary of your account. So as an example, we're just still in tax preparing season for 2024. You can call any of your vendors and say, can you email me a list of all of my purchases for 2024? So again, I can't say 100% that they're all going to be able to do this quickly and easily, but for the most part, most vendors, if they are, a sizable business, they have their accounting software. It literally should take them 60 seconds or less to run a report of your account and send that over to you. So all of this information is collectible, or you can gather it. If you have this paperwork, you can get it organized to a point where you can calculate this data. Oop. Okay, I think that's the end of my part of it. So I'm going to turn this over. Richard is going to start telling you about accounting.
Thanks, Chris. There are basically two types of accounting that you should be aware of: financial accounting and managerial accounting. Financial accounting records past transactions. What did you do this past month, this past week, this past quarter, this past year? There are strict formats and conventions, meaning that in order to do it properly, your accounting should conform to the chart of accounts for your particular business and generally accepted accounting principles, often called GAAP, GAAP. And that's one of the reasons why, if you're not completely familiar with accounting, you probably want to have a bookkeeper or an accountant work with you. Now, recording past transactions, just, you take that out of your point of sale system, your cash, your credit cards, whatever it happens to be, and you make sure that each one of those revenue channels is recorded properly. And then financial accounting should go through a periodic audit, normally once a year, maybe more often than that if there's any question about, are you recording things properly? And it's usually done by an accountant, a bookkeeper, or another professional provider if you're not fully comfortable with accounting. One of the things to keep in mind, and I briefly mentioned it, was the uniform chart of accounts for your industry. This is really important because you want to be able to conform to industry standards, not only generally accepted accounting principles, but the industry standards for your business. So, for example, a restaurant's uniform chart of accounts would be very, very different than, let's say, a beauty salon's. They're both service industries, but the chart of accounts and the way they account for certain things is different. And you get your uniform chart of accounts for your business usually from the trade association that represents your business. So, for example, in the hospitality industry, it's the National Restaurant Association and the American Hotel and Lodging Association. In other businesses, it's whatever trade association usually represents them. They set the standard for accounting. And if you're not a member of your state or national trade association, it's definitely worthwhile joining, not because of the just to get the chart of accounts, but because of all the education and other support facilities that they have available to you. Managerial accounting looks forward, where past financial accounting looks at your history. Managerial accounting is the process by which you have the tools to actually forecast what you are going to do in the future. It's simpler to do, but consistent with financial data. It should be realistic and done by you, the owner, with support from your accountant or other provider. And really what you're going to do is you're going to look at past history and you're going to say, January 2024 was a slow month of mine. So for January 2025, I know it's going to be a slow month. However, February is going to be just gangbusters because of Valentine's Day. So I saw that in my February 2024 numbers, and I'm going to use that to forecast a strong February of 2025. And that's how you do it. And if you go back and briefly think about, for example, airline systems, where the price to go from Cleveland to Chicago on a Tuesday might be $600 round trip. But on a weekend, it could be $1,000 round trip. Well, why? Because there's more demand on the weekends to fly from Cleveland to Chicago. The airline systems recognize that because they have history, financial history, showing the demand for weekend travel, Cleveland to Chicago round trip, and they charge a higher price. Okay, so that's an example of how that actually works and how you can use your history to forecast through managerial accounting what your future trend should be. You should also include things like weather. Did we have a blizzard one week? Was it sunny? Was it raining? All the things that could impact your business beyond just keeping your door open. And you should be aware of all that. And that will help you with forecast as well. Are there any conventions in town? Anything special going on that will impact your business? That's all to be tracked and will all help you in managerial accounting. Next, Chris. Okay, what does each type of accounting do for you? Financial accounting produces information primarily for others. It's produced by accountants, bookkeepers, or your accounting software, and it's a valuable history for stakeholders. Well, who are your stakeholders? Well, the number one stakeholder is you, but you may have investors, you may have lenders who are not investors, like your local bank, whoever you borrowed money from. Okay. Other stakeholders, it could very well be some of your vendors. They may want to know how well you did, and at a very high level, certainly not at a detailed level, if they are going to extend you credit. So that's what financial accounting is all about. It gives you a roadmap, but it also provides information to the stakeholders who you are accountable to. Managerial accounting, on the other hand, produces information primarily for you to project forward. You build a financial model of your company, and your SCORE volunteer, your SCORE mentor, will suggest to you, let's do a forecast for the coming year. And you ought to do it in October, November of the previous year, based on the history that you've accumulated. So that financial model for the coming year could be very helpful to you in a number of different ways. Number one, it'll show you profitability. But number two, as Chris was talking about with Walter's Window Washing Company, it helps Walter understand, where do I need to have money available that I don't have coming in, and where can I be putting money aside in my good months. So that's an example of how managerial accounting will work for you. Forecasts start out rough, but get better with experience. So, for example, if you were just starting your business right now, you wouldn't have any history for 2024. And for 2025, you're going to do your best guess based on your knowledge of your business. Okay. For that, you can use spreadsheets, graphs, or just plain old paper forecasts. I will tell you that your SCORE mentor has access to a really good Excel financial workbook that is great for financial forecasting. It does a 3-year financial forecast for you, showing you cash flow and showing you profit and loss. It's really good. It takes a little bit of work to get all the data in. You don't need to know any formulas. They're already in the model. All you have to do is have the right data to work with. And today, for the rest of my presentation, we're going to focus mostly on managerial accounting. Okay, let's talk about basic financial statements. Accountants and software produce 3 standard statements: profit and loss. That's usually called an income statement. Some people call it a profit and loss statement. Cash flow. Cash flow shows you whether you've taken in more money in a given period than you've spent, or you've spent more money than you've taken in. And a balance sheet. A balance sheet, we're not going to go into a lot of detail today. It's a simple snapshot of the health of your business. It's usually done, once a month, once a quarter, once a year. And it basically says you have more assets in your business than you have liabilities, or you have more liabilities than you have assets. And whatever the difference is between the assets and the liabilities, that's the value of your business. Okay. We're not going to go into that in detail. If you want more explanation on that, your SCORE volunteer will be more than happy to explain it, or your accountant will be more than happy to explain it. Okay. These statements, number one, they help you prepare your taxes. If you owe quarterly taxes, this is, one way to find out. Produce information that potential lenders or investors request. It is not at all uncommon for lenders to ask for quarterly or semi-annual or annual profit and loss statements and cash flow statements. They want to know where you are because they want to know how you're going to pay them off. Help you predict the future of your business by creating a financial model. Again, this is really important. This is managerial accounting. What can I expect in the future? And you develop that financial forecast, and then you compare actuals against the forecast to find out, what did I do right? What did I do wrong? What products and services did I sell last month that met my forecast or exceeded my forecast, and what products and services last month did not meet my projection, did not meet my forecast. And for the ones that didn't, you want to know why. And for the ones that exceeded, you want to know why. And again, looking at your products and services over a long period of time gives you a longer view and helps you forecast even better. It helps you predict the future for your business by creating the financial model, as I just talked about, and it allows you to gauge the health of your business. A lot of businesses, this is really important to understand, and I'm not going to spend a lot of time on it, but a lot of businesses do not make profit in the first 1, 2, 3, 4, 6 months. In the restaurants that I've opened and the hotels that I've opened, they very seldom made a profit in their first year. So you had to have enough operating cash to carry those businesses through the period that you believe you are not going to be making a profit. And that's where creating the forecast and following up on that forecast to compare actual against forecasted numbers is really going to be helpful for you, and it's a gauge of the health of your business. Chris? Okay. The profit and loss statement uses data on revenue and cost to determine current profitability. As we were talking about the break-even point, you're going to get those numbers from your profit and loss statement. It shows you how profitable your business is likely to be over time. And again, that's managerial accounting because you're projecting out into the future. It helps you prepare your taxes. It tells you whether you owe taxes or you can take a tax credit for a certain period of time. It demonstrates to potential stakeholders that you have a realistic path to profitability. If you go for a loan, whether it be from a bank or from another source of lending, or even an investor, they want to know that their investment, that their loan has a way of paying off in the long run. And it helps you pinpoint excessive costs or unprofitable product lines. And you may be selling steaks in your restaurant for $30 and just selling a ton of steaks. But if your food cost is 60% of sales, and then you've got your labor and your rent and your utilities and everything else, and you're losing a dollar on every steak that you sell, it's not a profitable item, and it may not be worth keeping it on the menu. So that's a really good example of helping you understand excessive costs and unprofitable product lines. Chris? Your cash flow statement shows potential lenders, yourself, and investors that you have a realistic view of your cash resources. And again, what a cash flow statement does is it shows you all the cash coming in, and it shows you all the cash that you're spending, and it then shows you the difference. Are you taking in more money than you're spending, or are you spending more money than you're taking in? It helps you predict and prepare for cash shortages. Cash flow crunch can sink a business faster than a lack of profitability. If you don't have sufficient cash flow over a certain period of time, and let's say that you've got an outstanding loan, and you have to go back to the lender to say, I've run out of money, I need more money to operate my business, they're not going to be happy about that. So it's really important that you get your arms around cash flow, because a positive cash flow in the long run will mean long-term profitability. It allows you to identify and plan for seasonal fluctuations in sales. Almost every business is seasonal. And then it allows a cash flow model to be created that can enable you to view what your checkbook will look like in the months ahead. And we're talking about your business checkbook. And that's really important. It's got to be separate from your personal checkbook. It helps you plan when to make major purchases. Do I have enough positive cash flow to make the purchase that I need to expand my business? And it enables you to predict how large a cash reserve you will need in the good months to prepare for the slow months. Okay, financial service providers, bookkeepers. Bookkeepers are going to be your lowest cost. They're very common. You can look at bookkeepers in the area that you're in. If you don't have one already, usually requires an associate's degree or higher in accounting, and they record financial transactions. So if you're not comfortable in using QuickBooks or Xero or FreshBooks or Peachtree or any of the other systems, you can turn your receipts and your invoices over to a bookkeeper. They will record it for you. An accountant usually requires a Bachelor of Arts or higher in accounting or business. And an accountant will help you interpret your financial information. A lot of SCORE clients that I've worked with have accountants that simply produce quarterly financial statements for them and dip into their checking account to pay their quarterly taxes and that kind of thing, but they don't help their clients understand the financial statements. A good accountant will help you understand what your financial statements are saying to you in the form of advice. And finally, a CPA, a certified public accountant, is an accountant who has passed a rigorous set of examinations and is certified by the National CPA Association, and they are licensed in every state. And so they have a higher degree of education and can provide a higher level of service to you. They are also more expensive, but in some cases, CPAs make a lot of sense. Chris? Okay, projections and ongoing accounting. Projections aren't just a one-time effort. You need to constantly update your projections once a quarter, once a half. I will tell you, in every business I have been in, we've done a rolling 3-month projection based on history of last year or 2 years ago, plus what we've done year to date so far. There should be a continuity between your financial projections and the ongoing tracking of your finances. You're going to create a budget on a yearly basis, and then you're going to use the projections to help you control that over time. Is business exceeding my budget? Is business off from my budget? Why? And now, how do I actually work those projections to bring things back in line? If you use an accountant, show him or her your projections to assure consistency. They can tell you whether you're way off, whether it makes sense, whether you've got your arms around the financial part of your business. And if you use accounting software, compare its financial reports to your projections. Your projections are usually not done in your financial software. You normally have an Excel model, or you do it just out on paper based on what you understand. If you don't understand it real well, you can contact customer service to understand the different customer service of your software company, or you can go to your accountant. Most of your accountants are very familiar with a range of accounting software. And collaborate with your accountant, jointly work on the chart of accounts. Ask your accountant to get the chart of accounts for your particular industry. Again, it varies from industry to industry, so it's important that you get that. Regularly review the financial statements and reports for trends and anomalies with your accountant. And if you've got other people, if you've got business advisors, your score mentor, whoever it happens to be, we're happy to work with you on this and help you identify trends that you need to recognize for your business. If results are unexpected, drill down into the data to find out why. And one of the nice things about accounting software is they all have tools that will help you drill down right into the nitty-gritty of your business. And use the data to identify your most profitable product lines, identify most profitable customer segments, which is also really important, and diagnose potential problems. Your customer segments can be divided by cash customers versus credit card customers, online customers versus customers that walk in your door. There are all kinds of ways of slicing and dicing your customer segments to look at which ones really make the most sense to you and which ones will be less profitable. Chris? Okay, finally, we're going to send you, as part of our slide deck, this glossary of general terms that you should be aware of. Chris and I both know that this session has gone very quickly for you. That's why we're sending you the recording of the session. And the slides is kind of like drinking from a fire hose, but it's really important. Now, we've mentioned your SCORE volunteer, SCORE mentor several times. If you don't have a SCORE volunteer and you want one, all you have to do is go to score.org, and there's a link there that says mentor or find a mentor. Just click on it, fill in the information, and one of the things that you'll fill in is your zip code, and the website will take that information in, send it to the appropriate SCORE chapter. If you're in the 8 counties that the Cleveland area serves, it'll come to SCORE Cleveland. If you're in Akron, if you're in Columbus, if you're in Toledo, if you're in Detroit, it'll go to the right chapter, and then we will contact you, to set up an appointment and start SCORE mentoring with you. Last thing I want to discuss is we have a follow-up session this coming Tuesday. And what we're going to do in that session is talk about some strategies you can use now that you understand the basic terminology and the basic tools available to you. We're going to talk about some strategies on how to evaluate opportunities for revenue growth and some strategies on how to use the information that you have to expand your business. So we encourage everybody here to sign up for that session if you haven't done so. And with that, I'm turning it back to Anita.
Okay, well, thank you. That's been a fantastic session. So much good information, and I think that it gives people a really good basic understanding, and one of the things, particularly the break-even point, is great for people starting their business to know how much working capital they're going to need to cover the deficit spending until they do reach the break-even point. So great information. There's one question: are there still bookkeeping firms who don't use the standard software like QuickBooks?
I'm not aware of any. It's the automation makes it so much easier, whether it's a bookkeeper or or an accountant. Chris, are you aware of any that don't use automation at this point?
I think it depends. If people are really, really small starting out, you can absolutely keep track of this stuff literally on a piece of paper or make your own spreadsheet in a Google sheet or something like that. So, depending on where you are in your business, you don't need the full, kit and caboodle of an accounting program, but keeping track of the stuff that you do have, like as an example, if you have your bank statement coming in, each check or expense, I would make a little notation. This was an auto expense. This I purchased material. This was I did something for an advertisement. So if on any paperwork that you have that tracks money coming in and out, if you can keep receipts organized, an accountant and or bookkeeper can pretty quickly put that stuff together. If you don't have anything, nor is it organized, you have the time to organize, but you have to have the time to collect all that information. So, to the degree that you can kind of stay on top of at least keeping it all in one place and making those little notations, you don't have to start out with an expensive
Yeah.
software program.
Yeah. And one of the comments that just came up, there are free small business software packages available out there. But once you decide that, this isn't your forte, you want to get some professional help, whether it be a bookkeeper or an accountant, they are probably going to use some form of software. And it's really important that you keep all your receipts and all your invoices, because if there's any question on something, whether it be from your accountant or Uncle Sam or the state of Ohio comes knocking on your door, those receipts and those invoices are going to be your proof. Just like for your personal income taxes, your business, there's no difference with your business. You need to keep those, and your accountant or your bookkeeper can advise you on how long you need to keep those documents, because the government may not come back tomorrow. Once you file your taxes, they may come back 2 years from now. So you need to have that as well.
One of the comments had suggested that Wave has a free version. And while this is true, my experience, it's not to say that you should or shouldn't use it. When you're setting up your chart of accounts, it's nice to have a bookkeeper or someone that can help. And they have many options, like 5 or more for different telephone expenses. They're missing some really important expenses that you can customize if you know enough how to customize.
Yeah.
But the free version, they really are going to try and get you into that paid. And the paid version is where you really get to run some reports to get the really meaty information. So there's logging all the information, and then there's reports that can be incredibly valuable for making business decisions. So but that it is a place to start, but might want to, like I said, a SCORE mentor or some professional guidance, because it's not easy and intuitive in my experience.
Right.
Okay, well, I think we've answered all the questions and used up all our time. So
Great.
enjoy the rest of your day and